All right, here's the follow-up video for how dividends are taxed in Canada. For this video, we're only going to focus on Canadian dividends, and I'll make a separate video for foreign and US dividends. The first thing you need to do is figure out if your dividends are coming from an eligible or non-eligible company, and most of these companies will disclose it directly on their website, and you can kind of also assume that most of the public companies you're going to receive dividends from will be eligible. Next up, you need to understand that the gross up rate in Canada is 38% on your dividends. So if you make $100 in dividends, you actually need to pay tax on $138 in dividends. Now, I know that sounds absolutely crazy. Why would you pay tax on $138 if you only brought in $100? And honestly, it's just an accounting transaction to make up for the tax that the corporation has already paid before you receive that dividend. Now, so that you don't get screwed, the government has put out a tax credit for these dividends. The federal tax credit right now is just over 15%, and then the provincial tax credit depends on the province you live in, obviously. In Ontario, for instance, it is a 10% tax credit, which means your total combined provincial and federal tax credit is actually 25%. So assuming that you make $100,000 in the province of Ontario, that's going to put you in the 33.89% tax bracket. That is the tax rate that you are going to have to pay on your grossed up dividends, which means your tax owing is $46.76 on the $100 in dividends that you brought in. Then to calculate our tax credit here, we take this 25.0198%, multiply it by the $138 that we had grossed up, and that leaves us with $34.53. When we subtract that from the $46.73 that we owe, we're left with taxes owing of $12.23 on $100 in dividends. Now, one thing that's kind of cool here is, let's say you made all of your income from dividends, but it was under $50,000. You would be in the 20.05% tax bracket, and that percentage is actually lower than the tax credit percentage, which means you would get money back on your eligible dividends if your income was that low. Now, as you make more money, that is not the case. And what you'll find is that capital gains are actually the most tax efficient, and then eligible dividends are sort of in the middle, and other income like interest or a salary is actually taxed the highest with the more money you make. Of course, you can avoid all of these taxes by doing the same thing through a TFSA or RRSP, but you are limited by the boundaries of these accounts. If you want to see how the rest of your taxes work or what it's like when it's not a Canadian company, make sure to click that follow button. Videos coming soon.